The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi, everyone. Basil Chapman, Tiger Technicians Hour on this 23rd day of April. My pleasure to be here Monday through Friday on market days at 877-927-6648. Great few hours we had here. John Logan, Steve Rose, terrific shows. And, of course, don't forget, Steve's got a workshop coming up, 2 workshops coming up. It's really the psychology of trading, and it's really important to know why, how, what you're doing in your trades. There's a wealth of information right there. So, and I also have 2 webinars coming up, 2 45-minute webinars coming up this Tuesday night. This is for subscribers only, but you can sign up to be able to get my newsletter for free for a month, and you'll at the same time be able to get those webinars. The first one is on Chapman wave methodologies, just the core aspects of counting the waves, looking at chart formations, what's the objective, and where you start your wave count, how the wave count works, etc. The second one is a follow-up to the 1929 match that I gave a webinar on back in, I think it was April the 19th, February the 19th. And this is perfect because I had said that within about 3 months, I hope to be able to do another one with a follow-up. And it's hard to believe that the Dow has been in this trading range. In fact, in my CD introducing the Chapman wave methodology, I remembered a cartoon that I had drawn. I think this is it. Yes. No, this is not the one. It's, let me just go to, I think it's page 456. Let me just type in here. 456. Before I do that, this one says, this couple's climbing this mountain, and they're climbing, and the guy turns around and says to his wife, says, "This reminds me of the stock market." She says, "How come?" And he says, "What goes up must come down," as they get to the very top. So 456 will be right here. And that has the couple's coming down with this little car. You see them flying down, his flowing in the wind, and then they're going up. And then as they get off this roller coaster, he turns around and says to his wife, "They don't call it Son of Wall Street for nothing." And both of those remind me very much of where we are in the market. Let me just go to this before we look at the analysis. Look, since that whole April period, we've been in a trading band between 18,000, basically 18,180, 18,200 to the 17,620, 17,570 area, just stuck. And even here, we're doing very much hugging that 9-period moving average, that purple line. And we'll see. Yesterday was a nice turnaround, but I expected that today we would see some kind of a pullback. And I'd said by about, I think I said 12:15 to 12:30, we'll see if the Dow is down minus 35 or more. That'll be a negative for the close. Well, we were down. Now the Dow is down 5. Let me run the numbers now. So let's go to this. The E-mini, first of all, is down a quarter point at 2100, and it's testing the highs. It's testing this. Remember, I spoke about it yesterday, this Chapman wave inside track repellent zone. So it's testing. If it can break from the 2100 level it's at now over the next day or so and push into the 2107, 2109 area, that's going to be very important because it's testing the all-time high of 2109.75. And it'll say that there's a good chance we're going to break above it before coming back down again. And let me just move this 120-minute chart, shows the cup formations vying with the arch formations. Now let me just move these things over, and you'll know that we'll be back to looking at our usual. There we go. Let me just move those away. Let me see if I can get this back up again. No, it's not there. That's fine. So this is what we're looking at. We're looking at the Dow down 7 at 18,030. We're looking at the S&P down at 1.25 points at 2106. The comp index is down almost 4 at 5,031. Having gone to the 5,000 is very important, because remember the all-time high was, what was it, 5,045 or something, 145? Oh, I shouldn't have said that. Now I'm going to have to look. Comp index all-time high was 5,132 back in March of 2000. Very good that we've come all the way back here. We've got 1 month to go for a left side, right side price time match in this particular index. I'll go into that a little later if I can. It's not that important right now. What is important is I want to run the numbers to show you a couple of things. And we've got the S&P, as I say, down just about a point. We've got the gold GC, nice bounce back, 5.40 cents. Remember yesterday I drew in that rectangle and I said the very key important level to hold is 1183.50. Today's low was 83.60. 10 cents above it. Amazing how these rectangle formations, this is what I'm going to be talking about in my overview section, this coming Tuesday night. And let me just show you what you can do. You can go right here to the front page of TFNN, and right there it says 2 free webinars. Join Basil Chapman for these 2 education entertaining trading webinars. This is the first is Tuesday, April the 28th, 5:30 to 6:15. And of course they archived. So if you want to sign up, but you say, I won't be there. What's the point? Well, they'll be archived. You'll be able to check them out, and especially if you're going to be able to get a month of my service free. And May the 5th, the 1929 market revisited, and that's on Tuesday, May the 5th, 5:30 to 6:15. All right, let's get out of that, and we'll go right back to our story. Our story is that gold has held that support level, but the MACD turned down and the stochastics at 35%. I'm suspecting that there's going to be a little bit of a bounce here based on the 120-minute chart. There's peak A, B, C. And I'm not sure we're going to get to the 1196 level of the 200-period moving average. I think we're going to reverse a little bit sooner than that. That's what I'm thinking. You'll know I'm wrong if you close above 1198 by Monday, Sunday night to Monday. It's going to be very important in the markets. Sunday night, the markets open in Europe, and we'll see what happens there. Now, silver is trying to bounce. It's okay. I really don't have any strong technical indications here for silver. The 120-minute chart tried to rally, kind of failed. This is wheel spinning. It's trying to come off the bottom. It isn't yet. I don't see the trigger. I don't see the tire hitting the gravel. It's still on the sand this morning, and the wheel spinning is still going on. Let's go to the copper. Now, copper is having a little bit of a bounce here, but it's really not a great pattern. My suspicion is that copper will test the low of the week of the 20th of March, 2.5525 in the continuous contract. That's going to be key. And if it gets there, it's probably going to go a little bit lower. Now, let's do a couple of things here. I want to go to the dollar DXY. The dollar is also, like many of these commodity-related areas, I'm including yields as well, you're just bouncing around within this fairly narrow trading band. It doesn't feel like a narrow trading band if you're doing it intraday or looking at it every day. But if you're looking at it on a weekly basis, this is nothing much. If the dollar starts to break the key support of 96, that's going to be very important. That'll be the first time we've seen lower lows and lower highs in the dollar index. We'll see what happens, all right? But pulling back like this allows the gold to rally. The dollar pulls back deeper. You will see that move a little stronger. You should see a little stronger move in the gold contract. All right, I want you to go to the TLT. Look at this. TLT, China rally had a lousy day yesterday. Did break the support. Support is there to be tested. When it breaks and you go underneath it, it says be careful, because you could get a 1-to-1. We've already got a 1-to-1 in the conservative way. I always count these things. If you go from there to there, and you just merely go click to go like this, new parallel, you'll see that we've gone even a little bit more. Yep, we've gone a little bit more than a 1-to-1. The next 1-to-1 will be to the 9-period moving average, which takes you to 127. All I can say is if 127 breaks on the TLT, then you're going to see bonds. And this is going to be very interesting. Look at this. This is the TNX.X. This is the 10-year. The 10-year is just merely doing these little bounces, but it is trying to form a cup formation. And that cup formation will become really important if there is a close in the 10-year T note interest rate index. If it goes over 20.09, closes over 20.09. Right now it's at 19.7, so that's 1.97%. Okay, the final thing that I want to look at was the VIX index. The VIX for the first time the VIX for the first time in quite a while is trying to make a stand in the whole 12.50s area. The low today is 12.52. Yesterday was 12.50. Day before was 12.51. A few days ago was 12.54. Before that was 12.86. Now it's saying, hey, wait a minute, my MACD is not that great, but I am showing just the slightest hint of a divergence. And my stochastic is just dead in the water at 16%. If the VIX suddenly goes higher, you want to see the stochastic of the VIX index, the volatility index, go above 20 to maybe 22%. And that's going to be very important. And I'm going to just do this, just waiting to see if there's a call coming in here. No. Okay. So if that's the what we're looking at, I wanted to mention that the VIX index daily is not anywhere close to as important as the weekly, because the weekly has stuck underneath and remained underneath the 9-period moving average for quite some time now, since it broke down the week of the 13th of February. It would make just one move above the 9-period moving average, especially if it's tomorrow by 4 o'clock tomorrow. If it goes above 14.11, that'll just be the start of a turnaround. It would take a lot more. It would take within the next 2 Fridays afterwards, going into the second Friday of May, you would need to see the VIX index up in the 1560s to the 1630 area, preferably 1660 area, to say now there's a turn, but it would have to be accompanied by bad news every day coming out to be able to, for the market to say, uh-oh, this is not good, uh-oh, this is not good, and respond negatively. If the market ignores bad news or ignores a VIX that tries to rally and fails, it's just saying buying pressure is still intense. That's the way I read it. There are many other complicated things that you can do with the VIX. Make it simple. The VIX goes to the 15s and 16s this morning, up and down, and holds there. All right? All right, I'll be back. Break coming up. 877-927.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they just recently unveiled the new 5-year market-safe Future Economies CD. This is a CD that could really deliver, but you have only until May 7th to take advantage. Consider the facts. If the Future Economies currencies beat the US dollar over the CD term, you'll get all of the upside. And should they lose? No worries. There's zero downside risk here, as you'll still get back 100% of your deposited principal. Intrigued yet? The May 7th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
Basil Chapman has just announced 2 live workshops that he'll be hosting April 27th and May 5th that only subscribers to his opening call will gain access to. On April 27th, Basil will host a 45-minute live online workshop, The Essentials of the Chapman Wave, where he'll teach the basics of the Chapman Wave notation that Basil created and uses daily in his trading and newsletter recommendations. On May 5th, Basil will host a second 45-minute workshop where this time he'll revisit the 1929 market comparison webinar and provide his attendees with an updated take on the socio-economic trends Basil has spotted currently taking place. If you're an opening call subscriber already, then your seat is already reserved. If not, then sign up for a 30-day free trial to the opening call today. You get a month of Basil's daily newsletter, The Opening Call, along with 2 live workshops coming up. Don't miss out on this offer. Sign up for Basil Chapman's Opening Call newsletter today on the front page of TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back, and the Dow, this is very interesting. Dow's down 19, S&P's down 1.63. One of the things about a rectangle formation is if you try to trade the rectangle formation, it can be extremely difficult unless you go to the top of the range, and that's where you're short, and you go to the bottom of the range, and that's where you buy, and you wait for the break of one of those boundaries. And so I just wanted to get that out there because it goes to another technique I spoke a little about it a little earlier, and that has to do with the rectangle formation. So I want to go to our first caller. We've got Mark in Denver. Hi, Mark. How are you?
Good, Basil. How are you?
I'm well, thank you.
Good. So the other day you mentioned the FXI, FXP. I don't know if I can't remember which one you recommended. And I went long the Yang, which is the triple inverse of the FXI, the other day in the low fives, like around 510, 515-ish. So let me know what your thoughts are.
Okay, so folks, we're looking at the FXI, and I did a little bit of a study of this the other day during the show. And one of the things that I was looking at was that there was a real good chance that it made a peak F top in the Chapman wave. And this is the iShares China Large Cap ETF. It was trading at 52.56 on the 16th of April. And I called that a peak F. Next day, it gapped down, and then it tried to rally, and it went up to 52.41, 15 cents lower, and today it's back down again. Forget about these gaps, because gaps in overseas traded stocks always happen. They are very different to gaps of United States companies. So what we're looking at here is that there's a G/C in the weekly, but I was also looking at the way that it tested this longer term Chapman wave inside track resistance, a red dashed line, and it stalled right there. I think risk reward, I believe that this is a good risk reward potential. Why? Because Yang, which is trading now at 557, made a low the other day of 5, was it? Yep, exactly 5, round number 5. So it's up. It's actually up a nice percentage. But of course, when you're trading with low price stocks, any pop up or any decline has a big percentage move. This is the way I'm looking at it. If it's going to work, because it was a choppy top that was formed, I like it way better than if it's just a single top and then a reversal after a very strong, powerful move. So risk reward, I can't do the 120-minute chart very accurately because this is the 3 times direction daily FTSE China Bear ETF. And I don't have enough points of contact that I can really use. But I can say that the on-balance volume and the stochastic have reversed quite sharply off the bottom. The MACD didn't turn down very much, and that's saying that it should rally. It won't rally all that much before coming back a little bit to retest, and then you'll see whether it breaks out, because you want to see the histogram, which is at 0.002, start to go positive. At that point, you have a greater chance of a continued move to the upside. So let me put it this way. I don't know what you'd have as a stop. I personally would make it even though if you put it 1 penny below the low of $5, because of the chart formation, it's possible that the very next day you could get a turnaround. But I would still, because the FXI has been so strong up until now, and the monthly chart still has a lot of upside momentum, you would need to see the FXI, which I'm sure you're looking at quite closely. You want to see the FXI within, let me put it this way. Today's Thursday. By Monday afternoon or Tuesday morning, it should not have taken out not just 52.41, but definitely not the 52.56 high. It should fail from about here, and it should quickly go down below 50.90. 50.93 is the 9-period moving average. At that point, your Yang would be in a little bit of a better position, and I would then say, now you can raise your stop just a fraction to make sure that you're not going to take a loss. You're going to take just a little bit of a gain at worst. But at best, what you need to see is the Yang move. You don't want it to Yin. You wanted a Yang. And if it's going to do that, 557 is the 9-period moving average. You want to see by Tuesday or Wednesday of next week a push above 557. I can't say a push above and then close below. I want to see it close, and I'm going to say to you, for the FXI to really be turning down, you want to see it close 2 out of 3 sessions above 557. Then I'd say I've got a lot more confidence that the FXI is going to pull back and your Yang is going to move higher. Hope that helps you.
Thanks, Basil.
Thank you, Mark. Good call. I'll be right back with John and Fully straight after this break. Dow's down 8, S&P's down a quarter.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks, we're back, and we're going to go straight down to Philadelphia. John and Philly, how are you?
Basil, I'm very good. Thanks for taking the call.
My pleasure.
Basil, I first want to pay you a compliment. During the past couple of months, as the S&P has been hanging right near the highs, you've emphasized and pointed out rotation amongst sectors, and I know you've been buying and shorting selected names in keeping with that sort of idea. But since stocks have gone nowhere for the broad averages are at highs and just kind of sitting there the past 2 months or so, I went through and looked at all my indices, including the Wilshire 5000, which I do work on periodically. Can't trade it, but it is the broadest and most complete measure of all U.S. stocks. And what I observed when I did it, the analysis on the Wilshire 5000, I noticed that the peak of March 2nd was surpassed with a higher high, just barely, March 23rd, and was surpassed again with a still higher high, just fractionally, on April 15th.
Correct.
And when I did the Chapman wave count, on the weekly chart, coming off that last October's low, we now are in a leg E as of last week.
Correct.
And on the daily chart, I have the Chapman count coming off the low of February 2nd as already peak F. So my question to you is, with those two particular labels and with those features, does that give us any? Does that give us a signal of anything in particular? That's my specific question.
Okay. Now, using the Chapman wave methodology, I have something a little bit different. I have the same counts as you, except I have something a little bit different in the daily chart. Besides the fact that there's a rising wedge formation, meaning that there's a slightly rising trend line from the February high to the March high to the April high, there is a far steeper incline from the bases, starting from the March 11th low of 21,577. So we're looking, the way I get it, I go dollar W 5,000. This is the Wilshire 5,000 total market index fund, full cap fund or index. And what's really important about this is that it kind of ignores a bunch of things because it's so big with 5,000. So yes, there could be some dollar impact. And yes, there could be oil impact. There could be a bunch of things. But basically, it's giving you the greatest weighting that you can get. So I too think that this is a very good market benchmark for the big picture. Now, if I'm looking at, let me just run this backwards. I'm going to go back to the daily afterwards. I want to show the 9-period exponential moving average, this black line here. You don't even have to know what the price is. You just look at the chart and you say, oh my goodness. If you had bought from the low that was made under the 9 EMA back in May of 2012, after that, if you had held on and said, I'm going to get out of this the month that it closes underneath the 9 EMA, I'll wait maybe one more month to see if it isn't a fluke or whether it's something that's real, you would still be in this position. And that would be from the 14,000s all the way to 22,349. So I want to just ignore that as a potential negative because we've still got a few days to go before we get to the end of April. But at this particular point, I can point out that the MACD has started to decline. It's what we call a divergence. When you see the technicals or important technicals go against the trend of the price itself. I always believe that price is the arbiter of a trend. And in this particular instance, the Wilshire is showing in the monthly chart that even though it's making nominal new highs, and that would be 22,369.06, 22,388, and then 22,391. This is in fact in the monthly F/B. At this particular point, I don't need to make a decision whether it's B or whether it's F. There's nothing here that says in price that I need to worry that it's even going to go close to the 21,500 9-period moving average. This is the most important thing. The stochastic pulled back, but then crossed back positive in April. The month hasn't concluded, but it has crossed positive, and it's at 88%. To me, 88% being nicely above 80% says there's internal strength, and at the same time, the MACD says, be careful, I'm your larger picture. The green line is usually what follows the price, and I'm not following the price. So you've got a divergence that at some point is going to kick in on the negative side, but I have to get those trigger points from the shorter term. So we go to the weekly chart. The weekly chart is a beautiful dashed line rising price with a rising wedge, and almost took it out, but in fact held the 9-period, this black moving average right there. It held this 9-period moving average, and it sprung off it earlier this week, and is now tackling the wick of the candle of last week. So that means that by tomorrow at 4 o'clock, if it takes out 22,391.88, that extends leg E. If it doesn't, we'll be looking to see whether it goes to leg F or whether it's recycled, that's a brand new B, all those other things. But the stochastics at 81%, good, not great, but good. And the stochastics, the MACD is doing the same as the monthly chart, but in microcosm, it's basically underneath. And at this particular point, it's at a minus 0.32, which says that it's just fractionally lower. So now it says I've got a slight divergence also in the weekly chart, but the price is holding beautifully. The rising wedge formation says that there's a chance that you won't go all the way to the top of the dashed line, or the resistance line, 22,700s. Rather, the slight incline here says it's a very familiar pattern. If anyone knows charts and knows the fractals of these charts that repeat over and over, that if you start to make tops that are not taken out over and over, that becomes a serious barrier, and very often you have to pull back to be able to build the momentum to power right through. So I'm watching this real closely, and all I can say is that on the weekly chart, a close, it's at 22,348, a close just 130 points higher. Yeah, 100 to 130 points higher will say to me, a close that is, will say, hey, wait a minute, mister, you've just broken out. This is probably recycling to the upside. Watch out. If you want to be short, that's not the time. As it stands right now, it says there's internal strength, but the internal strength is just beginning to show weakness. Now I can go to the daily chart, and the daily chart is actually a microcosm of the microcosm of the microcosm, because what it's showing is that the same fractal that we had seen in the weekly chart is showing up on the daily chart. And when I had looked a little while ago in the 120-minute chart, it shows the same sort of thing, that there's a lot of resistance in this trend line at the top. And this trend line at the top says, yes, you could go to a new high above 22,391, but it's not going to be very much higher. It could be at, that's interesting. What did I say for the 22? Yes, that's exactly right. And that says that if it's this week, it'll be 22,400, and if it's next week, 22,414. And that's going to be very strong resistance. So we're within about 130 points of tackling that trend line, and there's a good chance that if we hit it, we might not close above it. So I would suggest to you that you're right. In the big picture, this is still a very positive-looking index, but most importantly, it's showing that if it cannot power decisively through these resistances that have been showing up since late February, there's a good chance that it come back into the trading range, and then we will see, because if in the next 2 weeks there's a sell-off in the market and this index starts to decline and goes underneath 22,300, there's a good chance it's going to break this uptrend support, which is at 22,060. So I don't have any signals right at this moment to say that there's going to be a break to the upside, and I don't have a signal to say it's going to be a break to the downside. I do have a signal saying this little trading band is getting narrower and narrower, and that we are within, I would even say within 2 to 5 sessions of a break one way or the other, but we haven't got the break yet. Does that help?
It does very much. Thanks for that thorough discussion. I like hearing you go through all the whys and wherefores of those Chapman wave counts. So yes, indeed, we'll look for a resolution on that. Thanks very much, Basil.
I'm just as you wrap up, I'm just going to mention one other thing. The reason why I like the wave count that I've got, because that Doji Peak F on the 25th of February fitted perfectly with the MACD and stochastic. Then the rally that we had to a peak C minus, which became a peak C, which became a C minus on the 23rd of March, when the other indices tested their tested highs but didn't get to the highs. That's a turnaround date. And then the new rally started, a Chapman wave, overlapping wave, which went peak ABC underneath that March high, and then D went above it. D should have gone much higher and then come back to test the lip. It didn't do that, and it's showing that the momentum to the upside is starting to fail. I just wanted to mention that.
Very good.
Thank you very much for calling, John. Always very inquisitive questions, good questions. Let's go straight to, we've got Brent in Martinez, California. Brent, how are you?
I'm doing just fine, Basil. How are you today?
I'm well, thank you.
I don't mean to bring you like the most complicated name stocks that are out there, but so they got to pronounce it. But it's, I'm looking at today. This is another one of the beaten down, hated stocks I bought at actually a minute at 562. It's I just call it Vail. Makes it easier.
Yeah, Vail is, folks, this is Vail. It's I think it's an exploration company. Talk about a beaten down stock. I would say that a stock that goes from 22, most recently back in 2013, to the recent low of 5.45, I'd say that's beaten down in the monthly chart. And that was a sexy stock back in 2000, no, it was before 2009. I remember this was, oh, there it is. This was the stock that everyone went to in 2005, 2006, going into the 2007 level. Then it got very choppy, made its high at 43.96 back in May of 2008, plummeted to where? To exactly on the 200-period moving average. Folks, the webinar that I'm going to be doing this coming Tuesday night, the 28th of April, I'm going to be discussing very important key techniques that I use. The 200-period moving average, you don't even need to be thinking about it until something starts to come down or go up. And when it hasn't been there for a long time, in this case, it came down to exactly a double bottom in November and December of 2008 in the 8.60 area. And then whoosh, it ran up to 37.25 peak E. And then it came back, tested the 200-period moving average, couldn't hold it, and whoosh, it went all the way back. It tested it for about 2 months. And then, oh no, what am I talking about, 2 months? It's a year. It tested it in May of 2013, and then it tested it just once in July of 2014. Wow. And then it pulled back to the most recent low, and now the first level of resistance in the monthly chart would be 853, the 9-period moving average, and the 200-period moving average is way up at 14.36, so you can put it out of your sights right now until we can cross the first one, which is the 853 area. The weekly chart, nice. If it closes anywhere above 645, it'll be the first close above the 9-period exponential moving average since it broke down back in August of 2014. So it's a very important moment. And most importantly, it's already had an H pattern that failed, many of them, but the last one was larger in context. So this time you can actually start to form a cup formation. The cup formation says that very important candle in the weekly chart of March the 6th, where it opens at the 739.38 level, goes to 739, a penny higher, and then whoosh down to 623, closes near the bottom. That's the candle that would be the most intriguing, and probably I'd call it a bit of a magnet right now. Congratulations for seeing this. You've had your eyes on some of these. That PBR I saw last night after the news came out, it went up about 25 cents. And then this morning it came down, and what did it do? It went to that requisite leg D. Do you still have your position in PBR?
Yeah, if you don't mind me holding, I'll talk to you about it, Basil.
Okay, great. We've got Brent in Martinez, California. We're looking at Vail and PBR.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Do you know the 7 most critical factors that influence every decision you make, and how not knowing these will jeopardize the health, the wealth, and the relationships you deserve? I'm Steve Rhodes, morning host at TFNN.com, and for the last quarter of a century, I've studied and used the secrets of human growth, the same formulas used by leaders of nations, billionaires and millionaires, and the most successful athletes on the planet. Would you like to break through any obstacle that gets in between you and the success you deserve? Would you like to turn fear into strength? If you could find a way to achieve, be fulfilled, and live a life of meaning, wouldn't you want to know the answer? I'll teach you the factors that control your state of mind and the drivers that impact every thought, emotion, behavior, and action we take in my new webinar, The Psychology of Trading. Join me for this 2-part online event where I'll unveil the secrets to human pattern recognition, because they're not what you think. And soon, you'll have the health, the wealth, and the relationships you deserve. Just go to the homepage of TFNN.com and click on The Psychology of Trading to begin your journey now.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartley's, butterflies, ABCs, and Fibonacci in order to trade these markets. The Futures Hour, next on TFNN.
Now, folks, we're back. We're going to go straight to Denver. We got Jim in Denver. Jim, how are you?
You today?
I'm well, thank you. So you'd like to look at?
I wanted to call back and talk to you about Kroger. You said to call back today.
Yes. So just as well, we took a little time because yesterday was a pretty ugly day.
Yep.
And Kroger's now trading up 76 cents at 71.15. And most importantly, when we were speaking was in the 71s. Yesterday went all the way down to 69.60. Today it's got an inside bar. Now the question is that Jim has the core position, but we were right. But we were looking. You're looking to see if you could add for an intermediate term rally, a rally that should theoretically take it higher. At the time we were looking at it, we were thinking maybe the 74, 75 area, maybe 3-4 points. And if it managed even to break above the 72.5, 73 area, that would say that, yeah, we've got to be careful. There's not an arch formation forming in the weekly, but at least you'd be off the ground with some safety. So I'm going to make the suggestion here that if, in fact, the candle of yesterday is taken out to the upside, above a close above 72.05 would say, okay, just for the shorter term, the worst is over, and there could be a bounce. I don't like the weekly chart at all. So I feel that it would not be incumbent upon me to say that I can look at this as an intermediate term, buy and hold. More likely, if it does rally, I don't think it's going to hold the rally, and that it'll probably turn around at about the 73.75 to 74.75 area. So I don't know if you want to do anything with it in that regard. But I would say to you, in terms of a bounce at 71.17 with a 1 1/4 point stop, it would be a little bit more than that. No, it'd be almost a 3-point stop. I don't like that. You know, this is really tough, because all I'd be doing is saying to you that there's a chance of a bounce from here into the 72, 73 level. I don't know if it's really worth the risk of a 2 points up when you could have 2 points down. Right. So I'm going to say to you, if you think that you can follow it closely enough, you could have just a small position here at 71.17. I would say to you, I don't want more than 1.5 points stop on that position. Why? Because you could build a position that allows you to at least be in the position for a rally that has the potential to go to the 74, 75 area and then make decisions. But the most important thing is that the core holding that you have, don't close under 69. I'd say start putting in some kind of a stop on the core position. But on a short term, if you want to play a potential trade, yeah, I could see maybe a 2.5 to 3 point rally is possible from here. But you really need to close above yesterday's high to be able to formulate some kind of constructive cup formation. So I'm going to be a little hesitant here, and I'm going to say, my own preference would be to maybe step aside, but if you feel strongly enough that you'd like to try to trade it for a little bit, then a small position now, and you need to know within at least a few days it's closing above the 72.05 level. Does that help?
Sounds good, Basil. I appreciate it.
Thank you very much for calling. So, folks, before we go to Larry Pesavento, let me just do this. It should be a fabulous show, as always, with Larry. Let me just do this. The VIX index has gone to a lower low. That is not good. And I'm watching it real closely because as long as there's selling pressure, you're going to have bounces in the market. Now the Dow's up 50, S&P's up 6. And that's what we're looking at in the sideways move. You've got rotation that's pushing stocks up. Watch that very carefully. Watch the VIX very closely. At this level, it's giving buying pressure to the market. In the 1280s, it will give selling pressure.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.